All right, let's get started. Welcome everyone to this TradeStation webinar. My name is Jesus Nava. I'm the Director of Client Training and Education for TradeStation Securities. And today we have a guest speaker, Brandon Wendell. He's a trader and a mentor. It's a pleasure to have him here today. And we're going to get to his topic in just a moment, but it's a great topic because it talks about wealth protection and how you can use option strategies to protect your wealth. And before we jump into today's topic, let's go through some of the disclosure. Just keep in mind that every symbol and idea that we talk about is for educational purposes only, that these are not recommendations of TradeStation, and also that active trading is not suitable for everyone, especially when trading options, which carry a higher degree of risk. Also want to notate that Brandon Wendell, even though it's a pleasure to have him here today, he's not affiliated with TradeStation, so his ideas and trading methodologies are his own. If anybody here needs additional information on these disclosures, just go to tradestation.com/important-information. You see all the disclosure links right there on the screen. I also wanted to talk to everyone here about what is it that we're working on for Masterclass. Masterclass is an online offering, but right now we are offering an exclusive invitation. It's an in-person event that is going to happen in Chicago, September 24th. And I wanted to make sure that everyone here knew about it. I have shared a link with everyone here today. I'm going to share it one more time so that you know exactly which one I'm referring to. That takes you to the registration page of this masterclass. So if you're interested, please visit the link. It'll tell you a little bit about what is it that we're doing in masterclass. But we want to make sure that everyone is aware of this. And if you have an opportunity so that you can join us and meet us in person. Let me go ahead and also share with you an offer code that will give you a $100 discount. So if you use the offer code that I just shared right there in the chat, options 100, you'll get a $100 discount. Not to say that, let me just jump over here to the page of the masterclass so you see what I'm talking about. This is the link, or this is the page that you'll get to if you use the link that I just shared right there in the chat. But if you scroll down here, you'll also see a commission rebate offer. So not only are you getting a $100 discount right now if you register, but you're also getting a commission rebate up to the cost of your ticket. So that's another offer that technically makes the masterclass a no-cost event for those that are trading. So make sure that you visit the page, look at the dates, look at your calendar, and see if it's something that you'd like to attend. If you have any questions about the event, let me know right here in the chat, and I'll be glad to provide you any information. I also wanted to share a link that is associated with today's topic. If you see this webpage right now, it's titled Protect Your Portfolio from Market Volatility. And it just explains option strategies that you can use to do. I've also shared the link right here in the chat. Let me do it one more time. But it just provides a little bit more information about the topic that Brandon is going to cover today. So the link is right there. And I guess that's it. I'm just going to mute my microphone and turn off my webcam. And I'm going to turn the floor over to Brandon. Brandon, how you doing? I see that your camera came on.
Thank you. Yeah, I'm using my backup, unfortunately.
So it's all yours then, Brandon. Go ahead and take it over.
Excellent. Thank you very much. Thank you for having me. Appreciate you inviting me and TradeStation inviting me here to talk to everyone. Perfect. Well, welcome everyone. I'll monitor the chat as well to see if there's any questions that pop up. I'll try to answer those pretty much at the end of the webinar, so that way we can keep on topic. We're going to talk about protecting your portfolio from market volatility, which we've been getting quite a bit of recently in the markets. Volatility has definitely been going up, be caused by news events, earnings, or social media. A lot of that stuff has been going on quite a bit. So I'm going to talk to you about it. You can see my background here. I'm a chartered market technician. So I've got a master's degree in technical analysis. Been doing this since 1997, so quite a while. I've been teaching trading for over 20 years. I was a trader in back office operations for a brokerage, a hedge fund manager, but decided that I didn't want all the stress. So I just started trading for myself and help mentor people in trading. So that way they can benefit from my knowledge just the same way my mentor helped me. And it also makes me a better trader as well by kind of reinstilling these rules over and over again with the people I work with on a regular basis. So that's it about me. What we want to talk about is the material that will help you. Number one, we want to recognize the dangers that are in the markets. Obviously, there's always risk in the markets. We could try to minimize and manage it, but we can never eliminate it 100%. It's impossible. So what we need to do is identify when the dangers are growing and what we can do about it. There are definitely signs. The market likes to give warning signs before it actually spikes in volatility or drops in price or rallies sharply in price. Typically, when people talk about volatility, they're worried mostly about crashes, market crashes, or drops in the value of their portfolios. So we'll talk about some of the strategies you can use with options. Simplest one is a protected put for individual holdings. That's a single leg strategy to protect underlying stock positions. But we have a little bit more advanced, if you will, or sophisticated. I wouldn't necessarily say they're too advanced, but a collar strategy gives you an opportunity to protect your stock holdings, but at potentially a discount to just buying puts. Again, there are definitely advantages and disadvantages to those, and we will discuss them. And we'll also talk about creating portfolio insurance for our entire portfolio using index or ETF options. So instead of trying to insure every single holding, which can get very costly and time consuming, we can create an insurance policy, if you will, for the entire portfolio, but it has to be done correctly. And there are certain ways to do it and things to watch out for. So we'll talk about how to do that and how to choose the correct underlying security for that as well. Now, there's not a cookie cutter, one size fits all type of method for this for the market. So please make sure you practice any of these strategies in a simulated mode first before you deploy any live capital, and just practice. TradeStation has a nice simulated mode that you can use with real market data to employ these strategies and get better at them. And we want to make sure we do that. If you have any questions, there's a couple resources. I'm sure Jesus will talk more about them. Actually, I think he did put up some of the links, but there's also in TradeStation.com under Learn, you've got options education, and obviously the link that was there for protecting your portfolio, some of the articles and videos available. You can always email education@tradestation.com that Jesus put up there as well to give you to answer more questions if you have them regarding some of these strategies. So first, how do we know if the market's giving us some warnings? Like I said, it often will tell us before you get the big volatile drops or increase in volatility. And volatility, and really there's an index called the VIX, and the VIX is often referred to as the investor fear gauge. Even volatility in general is often referred to as an investor fear gauge because investors want nice, steady increases in the markets and therefore their portfolios. If the markets start to waver or look like they're going to go down, investors get nervous or fearful, and that fear and volatility goes up kind of hand in hand. In a way, fear drives volatility. The emotions that a lot of investors and traders feel drive them to take certain actions. They might buy protected puts or they have a sell-off. You've seen before, was it 2010? Trying to remember, I think it was January 16th, 2010, if I'm not mistaken. It's one of those things you kind of remember the date. There was what they call a fat finger, where somebody went to sell maybe 10 contracts and they sold a couple hundred contracts of the S&P futures, and that caused a reaction that sold off the market. Other people saw that, heard it on the news, and they rushed to sell, and it just became a self-fulfilling prophecy, driving the markets down to the circuit breakers. So that happens. Again, people get fearful. There's a lot of news going on about tariffs and other things happening in the world, wars. So there's a lot of fear out there, and we need to act based on logic and data sets, facts, what we're seeing in the chart. We can somewhat predict instead of simply react and identify opportunities or identify when we might need to move into safety. So for the most part, the VIX has an inverse relationship with the equity indexes. They move opposite to stock prices. Fear goes up, volatility goes up. That's because prices are typically moving down. Not always, but often. You can have a volatility increase when prices rally very quickly. So if markets are calm and rising, the VIX often stays low, and that's complacency for investors. They're happy. And again, when the markets fall sharply, Sometimes you get a big rise in the VIX, and it can actually double or triple within a single day. It happens quite often, unfortunately. If we go out to, let's see, I've got TradeStation open here. What happened? What did I do? Come on. I want to open my chart. Okay, we'll just get a new one. That was odd. I don't see a dialog box open. All right, EIX.X. And it's not allowing me to expand this for some reason. There we go. And let's go out to daily chart or even weekly if we want. Oops, did the daily. Go to weekly. And again, this is the VIX. You see the most recent spike there was in April. And we went all the way up to, it looks like 60 for that reading. We'll talk more about those readings and what they mean. And we've had other moves like that before. You can see back in 2024, in August, there was a big spike in volatility. And before that, we haven't had as big of spikes for a while, but there have been several. Typically, when you get above 30, that's where there's a little bit of concern in the markets and potentially some sell-offs. You can see we've had big moves. 2020 with COVID went way up. I think it was almost at 90. What's the high here? No, it's showing 76 actually. But again, that's the VIX, and it typically moves opposite of the equity markets. And you get, when there's what they call black swan events, big crises in the markets, you get big spikes in VIX, in the volatility, like the 2008 financial crisis. You saw the COVID onset and other things that happened. So typically, the VIX is getting a reading of investors' anxiety about what price movement might happen within the next 30 days. And typically, actually, the VIX is reading the volatility reading of the S&P 500, the broad market in the United States. I call that the broad market. I know a lot of people follow the Dow. The Dow's only 30 stocks, and it's not evenly weighted in sectors. It doesn't really represent the U.S. economy. The S&P is a little bit better. It's 500 different stocks that make up that index, and a little bit better weighting, mirroring a lot of the economy. Actually, the Russell 2000 might be best. That's 2,000 stocks, which again mimics the broad markets. And there are different VIX indicators or indexes for different underlying stock indexes as well. But for the most part, we follow the typical VIX that follows, again, the S&P 500. So what are we looking for? Danger. What are the signs of danger? When we have very low volatility, okay? So when we get extremely low volatility, there's a complacency in the market. People are way too comfortable, and it often precedes a potential spike. So that's something we can watch for. Let's see, came across a statistic. And it's a possibility, because if volatility goes up with a spike, typically you're going to be seeing, again, they move in opposite directions. So if the market sells off because volatility went up, you're likely to see it correct. And we have what's called reversion to the mean in markets. Pretty much all securities have reversion to the mean. What that is, that markets move away from the average and then come back. So if you get extreme readings, they will typically come back, and that would cause a big dip in the S&P or the NASDAQ to reverse and come back up. Absolutely. So when you get very low VIX levels, that could be a warning sign there's too much complacency, and there may be a sharp move coming very quickly. Or again, quickly is subjective. And even low VIX levels is subjective. It depends on the overall market as well. What was low years ago may not be low today. Again, I'm on the weekly here looking at 2020. We had low readings around 16. But then when we go forward, actually, I'm sorry, it was backwards. I think we had readings below 10 for quite a while. Yeah, you can see right here in 2017, 2018, 10 was very low. Okay, so again, it's subjective, and the markets do change. They go through different environments, and you got to be aware of that as well. Another thing you can look for is measure volatility on the charts would be the Bollinger Bands. And if you look at the Bollinger Bands on the indexes, the S&P, NASDAQ, Dow, Russell, when those bands contract, it usually leads to an expansion and, again, a big spike in volatility. But yes, this is going to be recorded, and it'll be available online for you. And we'll give you the links in a bit. Also, trend warnings. When you're looking at higher timeframes on daily and weekly charts, there's often warning signs that the trend may be in trouble. And I'll show you a couple of those, some of my favorites. Even economic data. Today at 2 o'clock, we just had a news release, Fed meeting minutes. Now, that's not necessarily a major mover in the markets, but it could be, depending on what was commented in those minutes during the meeting and how it may impact forward-looking cuts in the interest rates or possibly hikes. What is the Fed considering for the economy and inflation and battling inflation? So pay attention to earnings reports. If you happen to be a futures trader like myself, you may also want to pay attention to the USDA.gov of reports. A lot of people forget about those, and there are news reports that come out at noon while these futures markets are open, the grains and meats. Some of them happen after hours, and you have to deal with the aftermath when the markets reopen at 8 p.m. Eastern. And I mentioned before, it's the world we live in. Social media is big, and we get a lot of movement based on certain things being distributed through social media, whether they be truthful or rumors. So pay attention to what's going on around you. Don't be overly cautious and scared of every little data point, but take into account how might it affect the markets and how might that affect my portfolio. So as an example, this is the weekly chart of the S&P 500 index. Okay. And basically the price was going up, but there's several things happening here. I happen to use the RSI, Relative Strength Index, as an indicator for momentum. I use it a little bit differently than the way it was designed as an oscillator. You can use other indicators as well. But what we're experiencing here is called a negative divergence. Prices, as you can see, are making higher highs on the weekly basis. So the bullish momentum looks like it's good. But the RSI reading is going the opposite direction. It's making lower highs rather than higher highs. And I equate that to, just imagine the price up here for the S&P is a bridge. These are the supports for the bridge. As prices are going higher, we should have the supports going higher and touching that higher level on the bridge. If they're not reaching all the way up, that means the bridge is in trouble. It's not supporting the actual road, and that's likely to fall. So we have negative and positive divergence. Here, we're worried more about the negative. It's called that because prices are moving up, indicators moving same or sideways, sideways or down, making lower highs. Typically, the prices will move negatively in reaction to that. They'll become bearish. Additionally, the bands have contracted a little bit. You take a look back in history, and this is the narrowest that they've been in about 6 months. So volatility has become very complacent, and we're losing momentum. That's what happened. That was the beginning of this year in 2025. We had a pretty severe turn to the downside for a little bit before we were able to rally. And that's a 1,000-point move on the S&P that was forecasted in a way by what was going on in just a couple of indicators. And there were other signs as well. September, November also be a divergence. Are you talking about back here? No, you can't ignore individual peaks. I would say there was a divergence November, December right there, but you can't skip those other peaks in between. And this divergence only went to the midpoint. Notice the bands were not contracting. They were already pretty wide. But with the narrow bands and the divergence, that led to the turn. Again, we want to have evidence and multiple pieces of evidence possibly to help prove to us that the markets are going to make that turn. So the simplest way to protect individual positions is simply a protected put. And again, it's a very common method for protecting individual stocks or ETFs. And basically, buying a put gives you now you don't have to exercise that, but you get the right to sell your shares at the strike price that you purchase that particular put option. One put covers 100 shares. Obviously, just like insurance, you pay a premium to buy the put. You choose the expiration and, of course, the strike price that you want. Now, to determine the right option to use, the further out of the money you go or lower price put, it's cheaper, but you have greater risk because remember, you are going to potentially sell your stock at that strike price to recoup your potential losses or limit the losses in your underlying position. So you basically have to decide how much drawdown are you comfortable with? 2%, 5%, 10%? And also because you are buying options, you typically want to buy more than 30 days until expiration. The expiration or time decay, of the options, it's not linear. It doesn't go straight. It's exponential. It basically is somewhat flat, but curving downwards. And in the last 30 days before the expiration of an option, it goes extreme. So when I buy options, I often will only buy options with about 90 days till expiration. You do pay more for that, but if you do not use the protection, you could sell that option and recoup whatever time value might still be left. And that gives you an opportunity. I typically do not want to hold a long position in a call or put when there's less than 30 days until expiration, again, to avoid that time decay. So the problem is, obviously, this could be very expensive if you're buying puts on so many different securities. If you've got a large portfolio, you're paying premium after premium. As far as the risk profile, the max potential profit's unlimited because you own the underlying security minus what you paid for the protection for the insurance. And the maximum loss is determined by your strike price you choose. Basically, your purchase price of the underlying security and the strike price. Again, plus the premium paid. That would be your maximum loss. So if I think I have an example here. Yeah, if you have 100 shares of Microsoft, and I've got, as you can see, I had a nice profit on this 100 shares. I didn't want to give all that back. I want to protect the profits that I have. And what I was doing here is simply buying a put in front of the earnings release, so that way I'm protected. If the prices were to react negatively, I could go ahead and sell my shares by exercising my right from the put that I purchased. So again, figure out how much drawdown is acceptable to you. It's going to be different for every single person. You know, if you have a certain amount of profit already, you may be more willing to allow some of the profit to go and choose a lower strike put. If you have limited profits or you want to lock in as much as possible, maybe you have to go with a higher strike price to the current underlying value. So again, that determines what strike you want. Further out of the money or lower in strike price, cheaper, less protection. If you're at the money, that's a lot more protection because, again, you could sell your shares for pretty much what they're valued at currently, but you're going to pay a lot in premium. So there's not one size fits all, as I mentioned. You also need to know, how long do you think you need a protection for? And you can take a look back at previous moves in the market and get an idea of how long it took for those markets to recover. It's as simple as going out to a chart, perhaps, of the S&P 500. You know, if I were to go to SPX.X, on a weekly chart here, we see that this dip started in February of 2025, recovered all the way back up in June. So it basically was a 4-month drop and recovery. Well, you may not need the protection all that time. Perhaps you only need it for about 3 months. But again, make sure that you're going to be either selling the put to recover time value or exercising when there's 30 days or less until the underlying expiration of that put. So if I needed this insurance for roughly 3 months, I might buy a put that expires in 4 to 5 months. That way I've covered during the period that I might need. Plus, if I don't use the insurance, I could sell it and recover some of that time value. Again, it costs a little more, but it may be worth it to be able to recover. So being long, anytime you're long in an option, you have time decay risk. Further options, higher priced, less than 30 days till expiration. Keep in mind, really big time decay. You see that on your options chain. In this case, I chose, let's see, October 17th. I forget the date I was doing this trade. I don't know if it shows. Nope. And I had a 475 that I was buying because I was expecting prices to possibly pull back. It's at 503, and I was willing to take a drawdown to 475. The underlying purchase price, if I go back a little bit, I believe was 458. So I was still protecting myself, and I was buying a put underneath a little support area, giving the chance for support to hold and me not to have to exit my position. But if it went below that support, I was protected. So this is the analysis of that protected put. Again, it was 100 shares. So I bought one put at the 475 strike. Okay. So no matter what, as long as that put was still alive, it didn't expire, I had the right to sell my 100 shares at $475 by exercising my put. Since I purchased them at a lower price, I automatically locked in some profit. Yep. And let's see, was this? Oh, actually, this is 20 days after, and you can see there's still value in that put. So even if prices move a bit, if I don't exercise, I still have the opportunity, if I want to sell the put for some value because I bought a put that had a long-term expiration. Again, it's not going to lose all of its value, and I can recoup some of my premium that I paid for the insurance. So instead of just buying a put, again, it can become expensive, especially if you have many different securities you want to protect. You can instead do what's called a collar. A collar surrounds your neck or your head, and the collar strategy surrounds your stock. You're basically going to do the protected put, but add selling a covered call to pay for some of that put. So the long put, of course, again, there's time decay. In this case, that 475 put, I was buying it And every day I was losing $9. It was 9 cents per share times 100 shares. So I was purchasing that for $9.70 per share. Again, 100 shares, $970 for the cost of the insurance. But selling a call at a higher strike at 540 in this case, basically that's going to obligate me to sell my stock if somebody wants to call it away from me at $540. Now, if I purchase a stock much, much lower, I still get a profit. That's fine. Additionally, by selling this call, I am collecting this premium, and that offsets the cost of buying the put. What this does is it limits my downside and protects me, but it also caps my upside. If we go beyond $540, I may not be able to participate in that upward move for my stock because I might get it called away by selling that call. So it's a trade-off. I'm protected, much, much cheaper in cost altogether, and I cap my downside and upside. So obviously I would sell a call at an area that I'm comfortable selling my shares or in an area that I don't expect prices to get to before I end up closing out my position. Again, my protection, I can sell sell the put and buy back the call prior to their expiration. That way I close out the position and I still own my underlying stock if I've not been assigned. So you can see I was able to drop the cost to just a nickel or $5 to ensure my position for several months. That's it. Pretty simple. Again, it takes a little bit of time. If we compare the different strategies, this is doing the protected put, buying 100 shares and selling a put at a lower strike. That's protection, but I had to pay some money for it. Okay. My max loss is now limited to wherever I purchased the shares to the strike price plus the premium I had to pay. If we did the collar, again, I'm still buying the protected put, same strike, but I added the call. And this price, by the way, is including the price of the shares, which was somewhere around $500, as you can see. So I did it as this with the shares as well. But I was able to reduce the cost of the insurance quite dramatically. It's pretty nice. Okay. And of course, again, because I have that call that I sold, if we go at 540 or above, I may have to sell my shares. Somebody could exercise it even when it's not at 540. Just be aware, anytime you sell a call, an American style call, you are at risk of assignment at any time. If I did a closer expiration, in this case, it really didn't benefit. Be careful. It is nice that the call will expire faster and therefore the value would go down faster. You get to keep potentially the premium for what you sold, but at the same time, the put option also decays in value very quickly. And it may be more subject to higher volatility. You see these options have more volatility than what we had on the longer time frame. So just be aware of that and weigh out your options. So that's protecting individual positions, which isn't bad if you only have several positions. But if you've got a whole portfolio, maybe even some mutual funds you want to protect, you can't do the collar on the mutual funds. There's no options on the funds themselves, just ETFs and stocks. So going beyond the individual stock holdings, we can protect an entire portfolio by doing options on an index or index ETF. So again, if we want to protect our retirement accounts, mutual funds, we could potentially do this. We use options on ETFs or index options, and that helps protect our portfolio as a whole. So a lot of us hold stocks or even mutual funds that track the S&P 500 index. So you could buy puts on the SPY to partially hedge your portfolio. If your portfolio moves very similarly to the broad market, by buying puts on the ETF, that may move relative to your portfolio and therefore protect you. For larger hedges, it depends on the size of your account. Okay, and we'll talk a little bit about that. But if you have a larger account, you may want to do options on the index based on what's called their notional value. So I'll get into that in a moment. So some of the things you want to look at is pretty much the same. How much loss are you willing to take? So you choose your strikes based on how much drawdown is okay for your position and your portfolio. How long do you think you'll need the protection? Take a look at past drops in the markets. How long did it take for that to recover? Okay. I can't remember what it is. I think it's 18 months is the average bear market, but we haven't had one in a while. We just get dips right now. So if we want to protect ourselves from those quick dips and high volatility spikes, we may only need a month to 2 months, maybe 3 at max. So that'll determine which expiration we use. again, I try to make sure that I have at least 30 days left till expiration on the options after I'm done with the insurance, when I'm getting ready to close out the position on the options. And can you do this in your retirement account? Some retirement accounts will allow you to do these strategies in that account. Some of them will not. So you'll have to see how it is. Hypothetical situation. Let's say we have $100,000 in our portfolio, and you're okay if the markets pull down 5%, but you don't want to have a loss beyond that. And we're going to choose the SPY puts as protection. Okay. So a 5% drop. At the time I did this, the SPY was trading at 620. It's gone up since then, although it started coming back down today. Anyway, at 620, a 5% drop would take the SPY to 590. So if we're okay with that much of a drawdown, then I would use the 590 puts. Now, the notional value, basically, you take the strike, and for the option on SPY, you just multiply by 100. So basically, the 590 strike covers about $59,000 of exposure in the markets. If we have $100,000 in our portfolio, one's not going to cut it, because again, we're only basically covering, in that case, $59,000 of our portfolio. We have 100,000. So we may have to do multiple options. Buying 2 contracts doubles it. That's $118,000 of coverage. So again, we could buy 2 590 puts, and there's the price. It was $16.09 technically per share. We're doing 2 options. And again, the index, or the option, you multiply by 100 shares. It's obviously not a perfect hedge, because we were hedging $118,000 of coverage for only $100,000 portfolio, but it's close. And that's what we want to do, is get close. So the market dropped 5%. Your portfolio, 100,000, again, if you have a one-to-one relationship, which you may or may not, but your portfolio would lose $5,000. Your options would gain, in this case, approximately $2,300 in value. Okay, and you can see I did what was called a price slice to move price. I did not adjust for volatility. That would actually help. Remember, when prices drop, volatility would typically go up as well. And you can also look back to see, how did volatility move in relation to the previous drops? How many points did it go up? And you could add that in the price slice to get an idea of approximately, and again, it's only an estimate, it's not exact, but approximately how much would you recover in your puts to offset your loss in your portfolio. And of course, this is not including time decay, although I did actually adjust. Oh, this one I did not. But you can adjust time as well to get a little bit more accurate in the price slices. Okay. Actually, for backtest results and a little bit more, we can do that in the options replay. So you can check the schedule for the next options replay. I'll be able to do that and show you more of the practical application. This is the education portion. And again, there's some articles and videos accompanying this that are on the webpage that Jesus gave you the link to, and they'll give you a little bit more there. But in the options replay, which, let me see, again, if you go to TradeStation and events under learn, you'll see when the next ones are. There is one on Monday, and we could definitely discuss more of the actual practical application in the options replay. That's where we do it. Kind of show you step by step doing them and showing results. So again, in this case, buying 2 590 puts, that costs about 3.2% of the portfolio. So if you can keep the cost around 3%, 2%, that's great. You don't want to spend too much on insurance, obviously. You can adjust that, by the way, by choosing different strikes. Now, you'll notice that we did not have a perfect hedge. We lost $5,000 in the portfolio, but we only gained, what was it, $2,300 on the hedge. The reason why is the delta. We were not what we call delta neutral. And delta is, it does 3 things with options in general. One, it gives you an idea of how much the how much the premium of the option will change based on a $1 move of the underlying security. That's the main thing for delta. A lot of people also use delta to get an approximation of the probability of that option finishing in the money. It's not the most accurate, but it's a way that people kind of shortcut it. And lastly, it is a hedge ratio. So basically, we had negative 0.26 delta. The negative means that if the market goes up, this moves down in value. If the market moves down, then this goes up in value. The put moves opposite. So when the S&P dropped by 1 point, the put premium only gained 0.26. Now, remember, when we were doing protective puts and collars, we were able to get rid of our stock by exercising at the strike price. With this hedge, we're trying to offset losses in our portfolio by having the value of the option go up and potentially selling the option for a nice profit. So if we need more profit, we need to hedge with the proper delta. Otherwise, as you saw, we only made half of what we lost. It still offset a lot of the risk, but not all of it. So buying additional contracts can increase our delta. If you want a one-to-one hedge, you need a delta of negative 1.0, or as close to it as possible. It's not always possible to get that. So if we bought 4 puts, what would that do? 4 times negative 0.26. The delta increases to 1, actually it should be negative 1.07. So when the market dropped, your options would gain in value 1 for 1 for the drop. So you would gain 5%, but your costs also went up. It doubled to 6.4% of your portfolio, but you had a 100% hedge, actually made a little profit when the markets dropped. That's not really the goal ever, but it's nice if it happens, obviously. So in this case, again, 4 puts, it's the 590 strike again, right there. The delta, negative 1.0766, or 107.66, they multiplied by the 100 shares. So now when the market dropped, you can see 5% drop down to 590. This made nearly $5,000, which is the equivalent of what was lost in the $100,000 portfolio. Now, deltas change as prices move. You may need to adjust your hedge, okay? Because time decay, obviously, it decreases the gain. That's why it wasn't 100%. So time decay eats into it. Volatility will also change the values of those options as well. Volatility increases, it can help your position. And the delta, as I mentioned before, it will adjust. Gamma is actually the rate of adjustment. So you have to monitor your position. The deeper in the money those options go, the greater negative delta you will get, and you may not need as many options. You might actually be able to remove one of those by selling it. Perhaps I only need 3 options now to maintain a negative 1 delta. So you actually do have to be a little bit more on the ball, if you will. Not every single day, perhaps once a week or once every 2 weeks. Monitor what's going on in your hedge and adjust as necessary. See if you still need it. If the market's continuing to move in the not necessarily wrong direction, but down, it'd be the right direction for the hedge. So dealing with delta again, options don't move 1-to-1. They move based on the delta. Deeper in the money options approach negative 1. At the money options have a roughly 0.5, or put options would have negative 0.5 delta. And deeper out of the money options go closer to 0. So they don't respond nearly as much. So the deeper you go for your drawdown on the strike prices, the lower delta you will have, and you may need more options to create your hedge. Just keep that in mind. So what you can use is a formula to roughly estimate how many options you may need. And it's basically your portfolio value divided by the strike price of the ETF you chose times the delta of the puts times 100 shares, okay? And that would be how many contracts you need for a full hedge. Okay? So again, if I had $100,000, if I was using the 590 with negative 0.26 times 100, that shows 6.5 contracts. You can't buy a half contract, so I can go down to 6 and be a little under hedged. But again, as prices go down in the index, the deltas will increase and it'll start to level out. Or I could go with 7 and be overhedged and sell some of those contracts as necessary to maintain the neutral hedge. Okay. I'm not going to be able to do that today, Lewis, but we can do that another time. Again, in the option replay is more appropriate for that, because that is a nice tool. The probability cones that are available in TradeStation give you an idea of how prices are likely to move in the future, and that can help you with choosing which strikes you might want to use. So yes, that's something we can definitely talk about in the future. Again, in the options replay on Monday. So this was just an example. Again, I did 6 options, and you can see, again, I did take some time value off of this one. I went about 30 days to get time decay. And when prices dropped to 590, because this had a little bit extra for the delta, you see the delta was actually 161, it actually made a little more than the $5,000. However, here's the thing to think about. A full hedge might not be the right choice because what if prices go up? You're not participating because you're going to lose 100% of what you're gaining in your portfolio in the hedge. So you may not want to do 100% of your hedging. You may only want to hedge a portion of your portfolio altogether. So keep that in mind as well. Another thing to think about is if you have a larger portfolio, you may want to use the SPX index options rather than the SPY ETF options for one simple reason. They have a larger notional value, you may not need as many. The SPY is only 1/10 the value of the index. So if the SPX is at 6,200, the SPY is only 620. So that means it was valued as $62,000 for the SPY, $620,000 for the SPX. So the index options are the equivalent of 10 SPY puts. So if you see yourself needing roughly 10 puts to hedge yourself, you may want to choose the SPX index options instead for 10 or more. Again, at a 590 put for the SPY, that's only $59,000 of coverage per put. The SPX offers $590,000 of protection. So choosing between the two, again, smaller accounts, if you don't need the $590,000 of protection, then obviously you use the SPY. If you need more protection, or if you do that calculation with the formula I just showed, and you see you need 10 or more puts, perhaps you choose the SPX instead. And typically when we're looking at larger accounts, probably $500,000 or more. That's where you're really going to start using the index options rather than the ETF. Another thing to think about is if it's a tax-sensitive account, meaning you have to worry about wash sales, taxation issues, the SPX options, index options are taxed differently. I'm not a tax professional, so I can't go into detail on that. Talk to someone who is. Trader taxation, that is. But there are different ramifications trading the SPX options, index options versus ETF options. So again, as a hypothetical, if you had $1 million in your portfolio and you are willing to withstand that same 5% drawdown, you could use the index options for protection. If the index was trading at 6,200, again, 5,900 would be the 5% drop. So one option provides roughly $590,000 worth of coverage. Buying two is over $1 million of coverage. Now, again, it's not a perfect hedge. We also have the deltas to deal with as well. You can see this is only with two contracts, -51 delta or 0.51. So if we wanted a perfect hedge, we would actually need 4 contracts to have a 1-for-1 increase in our premium to offset the loss in our portfolio. So it also comes into play here as well. So again, if the market did drop 5% on $1 million, you lose 50 grand in your portfolio, but you gained, in this case, roughly $25,000 in value. Again, you got to account perhaps for volatility and also for time decay as well. So that's going to reduce the protection for time decay. Volatility increasing, though, will help you with your hedge. So again, to fully hedge the portfolio, you could do 4 puts that I mentioned before, or 6% of the portfolio value. It seems to be close to the average for a complete hedge, roughly 5 to 6% of the value of the portfolio. But again, we may not want the full hedge because if the prices go up, even though we're covered, if things go down 1-for-1, we're also losing or not participating in the upward move either. So in this case, we're close to 100 delta, negative that is. But again, it prevents any gains. So perhaps you only want to hedge 60, 70, or 80% of your portfolio. So that way, if the markets were to go up, you're not missing out on that opportunity as well. So that's what I've got time for today. I know there's a lot of questions about probability and other things. I will go into those on Monday in the options replay, so you can join us there for that. But we did talk a little bit about finding some of the dangers using certain indicators. I do not have an actual platform or workspace that I use. I created my own and just add certain indicators that I like to use. There are some pages or workspaces available in the options education center and TradeStation you can use as well. Does it make sense to do a protected put and a stock position at the same time? You could. Absolutely, it could make sense. If you're worried about prices dropping when you go into a position, you could actually do that. TradeStation does allow in OptionStation Pro, for instance, when you go to the spread filter, you could do, I think it's this one, covered married stock. So for instance, if I were going to buy the SPY right now, I could also buy the put at the same time. See if it puts that in the order. There it is, open 100 shares, and it is buying to open a put. Now, I wouldn't buy at the same strike, perhaps, of what I'm buying. Again, I want to be able to have a little drawdown, perhaps, and not spend as much for the insurance. So I choose how much drawdown am I willing to accept. So you could do that. Yes, absolutely. So we talked about, like I said, the protected puts, the collar strategy to reduce the cost by selling a call on a protected put, and creating insurance using index or ETF options. And again, there's a lot of great questions that popped up, and I will be more than happy to answer those either by emailing education@tradestation.com and or coming in on Monday for the options replay. I'd be more than happy to go through some of those back examples. I'll have some ready for us as well that we can look back and show how some of those options may have worked on hedges. So I want to thank everybody for being here. And that's another topic. I don't have time to get into that right now, Amar. I'm sorry, I got to run. But I want to thank everybody for being here. And I want to thank TradeStation and Jesus for inviting me. Yeah.
It's always a pleasure to hear these presentations. Great, great, great content. Thank you so much, Brandon. Thank you, everyone who attended this webinar. As I said before, there is a link to a web article that was actually drafted by Brandon as well that talks a little bit about this topic, a little bit more about this topic. So make sure that you visit the webpage, look at all the different information that's there. And if you have any questions, please make sure that you use the email address that I shared with everyone here. If you're having difficulty accessing or finding any type of information, we're there to help you out, okay? So thank you, everyone, again. Check out the events calendar for upcoming events. And don't forget about the TradeStation Masterclass, the in-person one that's happening in Chicago, September 24th. The link is also in the chat for those that didn't get to it. And you can always ask me questions through email as well. Brandon, again, thank you for your time. And I'll see everyone in a later event. Have a great afternoon, everyone. Bye-bye.